This meeting is being recorded.
Good evening, good afternoon, good morning, whenever you are. This is part 8 of the Become the cTrader Master webinar. Today, we are going to talk about the leverage, dynamic leverage, and smart stop out. So let me just switch straight on to the cTrader platform. This is what we are looking at right now. So this is the cTrader platform, and I would like to show you something that will be directly connected with the this section here. This section here to the downside. It's called the trade watch. And we will be working with this panel today. So what I would like to show you guys is the first thing is the dynamic leverage. What is this? We will talk about it. Don't worry if you don't know what's the leverage, what's the dynamic leverage, and how to use it. So the first thing is that if you have a standard platform, let me just switch it to the full screen. There you go. If you have a standard platform like cTrader, okay, downloaded and running, you can see that for example, euro-dollar market or the British pound market, it doesn't actually matter. It can be New Zealand dollar or whatever you like. You got this right hand panel here, which is called the panel of the active symbol panel, and this panel here at the very end has the leverage module. And as if you there's a slider that makes you helps you to roll down here. If you click on it, and this is what you get this mysterious thing here, which is quite difficult to read at first, but we will take a look at this in more details, and you will find out that this is very, very easy and very, very helpful, especially if you are the beginner trader. What you see here is exactly the dynamic leverage, and this is the volume of the overall trades that you are planning to have, or you are actually, of course, having. So this is what we will be talking about, and something else here we will talk about, which is called the smart stop out. Nonetheless, there's one more thing I would like to show you that has not been introduced before, which is the presentation. And for today, I have prepared my presentation for you guys. So here it is. Let it be right now seen on my of course screen. Dynamic leverage and smart stop out in the cTrader. We will going to explain the dynamic leverage, how the dynamic leverage works, as well as how the margin used is calculated in the cTrader. So the margin used by open positions is related to the leverage given for each position opening, and dynamic leverage can be set to work in two different ways. One method, of course, recalculates the margin requirements upon each event, and the other calculates the margin requirements upon opening of the position, and it's constant throughout the lifetime of the position. This concept will be explained further. Everything, of course, what I will say here about the leverage is important, and it's urged that all of you, especially if you are a beginner trader, understand this. So what is basically the leverage? The leverage is the ability to use borrowed money from the broker for investment, and using leverage, you can deposit your own money and use it as a collateral to borrow much larger sums from the broker for trading. The leverage ratio is a ratio of the deposited to the borrowed funds, and the margin is the certain amount of your own money set aside as allocated as a collateral in like a good faith deposit required to open a position with your broker. The size of the margin depends on leverage applied, and exposure is like the amount of the asset at risk. So the exposure is calculated per symbol and depends on the direction of the trading, of course. The positions of the same symbol in the same direction increase the exposure, while the positions in the opposite direction decrease it. Okay, so as the volume per instrument of a client, of a trader, increases, the maximum leverage offered decreases accordingly. This is very important for you guys to understand. So let me just tell you a little bit about what are the different leverage types. Let me just switch back to my cTrader. Each trading account has a certain leverage defined at the time of creation. As you can see, I'm using the live account right now with leverage 1 to 30. If I will switch to the, for example, demo account, which will be right now, there you go, it's applied now, and it's the account leverage is 1 to 500. So each trading account has a certain leverage defined at the time of the creation. However, when entering a trade, the actual leverage might differ because of the different symbols can have different leverages. Okay. For example, while the most of the time you can get 1 to 500 leverage, as you can see here. For major currency pairs, for example, if you have a euro dollar, you can easily see that we got the euro dollar is here. Let's say, okay, British pound, doesn't matter, volume remains any, and the leverage is 1 to 500. So for major for example, for this kind of market, which is a forex market basically, and the euro dollar is the main, or British pound is to the American dollar is a main pair. The broker, and then TopFX as well, may offer much lower leverage for highly violate pairs or forex pairs, or I don't know, stocks, or I don't know, natural resources, precious metals, and for example, sometimes even for the cryptocurrencies. And this leverage might be between 1 to 10 to 1 to 50 or 1 to 30. In such cases, the account leverage is treated as the upper limit. So if the symbol's leverage is the smallest, is smaller than the account leverage, then the symbol's leverage will be applied. If the symbol's leverage is bigger, the account leverage prevails. So for example, let me just find out. Let's go to the, let's say, metals, and let's see gold. And this is the gold, and as you can see, the leverage that is going to be applied for your trading will be 1 to 200, despite the fact that your account leverage is 1 to 500. Okay, I think that this is really easy to understand. Different volumes of the same symbol can have a different leverages, of course, depending on volume. So that's the basics of the account leverage, right? But what's the dynamic leverage? Dynamic leverage is a volume based leverage, and this leverage is very specific because it changes depending on the exposure. So let me just find out for you my account, live hedging account with 1 to 30, and you can see that here on this account with that leverage on the same pair, XAU to USD, on gold to American dollar, we have a dynamic leverage. The higher the exposure is, the lower the leverage the broker usually provides. So if you want to check it, you check the dynamic leverage of a symbol, you know what you do. You check the symbol here, or you check the symbol here. For example, right now I'm going to check euro dollar, and at the very when you scroll down to the leverage section, you can see the dynamic leverage section. The leverage volume is always noted in the USD, in the American dollar, regardless of the symbol. So online Forex and CFD brokers are using dynamic way to calculate the margin requirement needed to maintain a trade. Okay, so this calculation is automatically adjusting the required margin needed for each open position. Throughout this way, client is enjoying lower required margin or smaller volumes, which is increasing dynamically as the volume builds up. So as I said before, you need to know that as the volume per instrument of the trader increases, the maximum leverage offered decreases accordingly. So let me just show you basically the example of the dynamic leverage in the Forex. Let's say your account leverage is 1 to 500. So consider this is a euro account, and you want to buy 300 lots. You want to buy or sell, it doesn't actually matter, buy or sell 300 lots of the euro dollar. So in this example, the account leverage is greater than the symbol's relevant values in the, for example, this leverage monitor on the bottom of your active pairs module. So the margin required would be as below. So what do we have here? From 0 to 100, the maximum leverage is 1 to 500. That's no doubt about it. And the margin calculated here, as you can see, is 20,000 euro. But then that's only the first 100 lot. You still have 200 left. So from 100 to 200, the maximum leverage is 1 to 200. So your margin will be, after calculations, 50,000 euro. And then the last 100 lots will be traded with the maximum leverage of 1 to 100, and they need 100 euro as a margin. So the total required margin is 170,000 euro. And if you calculate it right, you can see that in this case, the utilized leverage is 1 to 176.47. So it means that for this kind of orders, as you can see, 300 lots, 400 lots, even more, maybe 107 lots, something like that. The broker is using the dynamic leverage, which is of course much more better solution for this kind of big orders than the static leverage provided by the account type. For example, 1 to 500 permanent leverage. So you need to remember that there are some rules as well of the dynamic leverage, right? So what are these rules? The rules are, well, unlike the normal leverage condition, there are some rules actually when you use dynamic leverage. First thing is that the present account leverage will be considered for, of course, Forex. The account leverage won't affect metals margin requirement, and it's relevant only for Forex margin calculation. If the account leverage is less than a leverage level mentioned in the dynamic leverage table for Forex, then account leverage will be considered instead, okay? And as volume is increasing, as your exposure is increasing, if the account leverage is greater than the appropriate leverage level, then the value from dynamic leverage table will be taken into the consideration. So you are going to use, of course, the dynamic leverage. This dynamic leverage calculation is based per symbol separately, okay? So if an account is trading multiple instruments at the same time, then the one instrument won't affect margin required for another instrument. In case of the hedged positions, the direction with larger volumes will be considered for margin requirement, and the required margin is always calculated on base currency for Forex. So in that situation is the US dollar. For metals, calculation is based on the currency denominator for each instrument. For example, if you are trading gold to the American dollar, then the calculation is on the currency denominator, which is American dollar. If account currency is not the same, then appropriate current rate is being used in order for required margin to be shown in account currency. For example, if the account currency is in euro, then of course, and you are trading euro dollar, then you need to recalculate the current euro dollar rate first before you make the calculations. However, most of them, these calculations are made automatically. So that's the dynamic leverage. I hope it's being now much more easier to understand and much more easier to see on your cTrader platform. And the next we are going to talk about is smart stopout. What is a smart stopout? Well, as a trader, you should already be familiar with the concept of stopout. And if you are not ready to start trading yet, get back to that and educate yourself just a little bit more, because stopout is an event that happens if your margin falls below a certain threshold. All right, so when your trading account free margin falls below this level, your broker will start closing your positions. The level at which this happens is controlled by your broker, and it does vary from broker to broker, of course, and cTrader stop out is almost always an automated process that is performed by the trading platform itself. And of course, please notice the fact it's not by your broker employees. Okay, so if you are using TopFX broker, they are not performing the stop out. It's automated process. Well, while all Forex and CFD brokers do this, it's how they do this that's important. So not all trading platforms stop out accounts the same way. cTrader supports the stop out methods. There are two stop outs methods, which are totally different to the way the other popular trading platforms, such as MetaTrader 4 or MetaTrader 5, do it, right? So stop out methods supported by the cTrader are called smart stop out and fair stop out. Okay, so the regular stop out or smart stop out, the method which is used in your trading account is selected, of course, by your broker, and the TopFX has chosen the smart stop out as the manager of the stop out. Okay, so the stop out is a unique feature. Please remember, it's a unique feature of the cTrader, and the use of this phrase is a specific to cTrader. Smart stop out is a method used to close your position when you do not have enough margin to maintain them. So the method will partially close your position, starting with the position using the most margin. So the classical stop out closes the largest margin taking position entirely. It doesn't matter if this is in profit or not. It's being closed automatically and frees margin to protect the remaining positions, right? The stop out logic in cTrader is used to maintain the margin required by the broker for the account to keep the positions, of course, and cannot be disabled. It cannot be changed. It cannot be switched to another method. With the smart stop out, you have the benefit of staying within the required margin level and maintain your position for as long as possible, opening the opportunity of being able to bounce back. For example, if your position bounce back in the direction that it will be in favor for you, right? Of course, which wouldn't happen if your position were entirely closed, right? The smart stop out provides maximum protection to your account and positions, and it progressively closes your positions only partially by the smallest increment, right? Typically, the steps are 1,000 units of something, usually units of the currency, which means 1 micro lot, 0.01 lots, okay? In order to keep your margin just above the stop out level, if ever it should fall below. So this is a feature that benefits the traders massively. So with smart stop out, when stop out level is reached, the cTrader will partially close the position which uses the most margin, and doing this will keep the margin level just above the stop out level. So this logic will only close what is an absolutely necessary by shaving off part of the position in the smallest possible increment, depending on how much margin needs to be, of course, released. It protects margin, it protects position, and it protects the balance, right? So this is a unique feature of the cTrader, and the use of this phrase is specific for the cTrader. So let's just find out, because there's much more of a talking here, but let's find out the smart stop out example, right? So let's say that we have this account with the balance of $1,500. Let's say the equity is, of course, the same situation, $1,500. Margin used is 0, right? And the free margin is, of course, 1,500. Leverage is 1 to 200, and smart stop out is set at the level of, let's say, 50%, right? So let's now say if this account opens 2 buy positions, US dollar to the Swiss franc at the entry price of 0.95. So what will happen? As you can see, we have the position 1, volume is 2 mini lots, position 2, volume is 1 mini lot, direction is buy, US dollar to the Swiss franc. So the margin required is $1,000. The second margin required is $500. Entry price is the same, p value $1.90, and the other p value is 95 cents. These 2 positions use 100% of free margin, okay? So over time, the price of the US dollar to the Swiss franc drops by 263 pips. And let's say that now the price is 0.9236. This will cause unrealized profit and loss of 750. And margin level now becomes 49.99, which is less than 50%, which is of course, the stop out. This triggers smart stop out. So in the case of the smart stop out, position 1, okay, will be selected to be partially closed, since is the position using the most margin, okay? $1,000 is using from the account. Smart stop out will close the position in increment of 1 micro lot, so 1,000 of units. This is the minimum amount that can be closed. Simply that's because position 1 then is reduced by 1,000 units when closing part of the position. A seal deal is required. And this causes some profit and loss to be realized. Okay, so we realize the loss of 1,000 US dollar to the Swiss franc at 263 pips at 0.095 per pip. So that, after the calculations, will be $25. You can check out for yourself. Even though the balance of the trading account has been reduced by the $25, the amount of margin that was made available is $50. So because of this process, the margin level of the account is now 51.72%. So now, after these operations, the situation on this account looks like this. The balance is 1,475. The equity is 749.88. Margin used is 1,450. Remember, the amount of the margin that was available was 50. So right now it's 1,500 minus 50 is 1,450. Free margin is, of course, minus 712, and leverage stay the same, 1 to 200, and smart stop out is back on the level of 50%. Okay, so this is the situation that happens on the account, which is why this this mechanism, smart stop out, being used by the cTrader, protects the account from closing the whole position of position one. In the situation, of course, this position was in loss, and it still the rest of the position still can be, of course, maintained. Okay, so that's the current situation on your accounts, and this is, of course, trading using this kind of a setting. You are winning your, because you are in long trade. You are buying the US dollar to the Swiss franc. You want this this market to go up. Unfortunately, it went lower, which is why you are still able to maintain the current situation on your account, to maintain the all of your positions, and wait for the market to rebound or bounce, for example. Yeah, this is one of the probable market moves that might happen, right? Of course, the market might go even lower, so then this position of 20,000 will 20,000, now it's 19,000, so another 1,000 will be taken out by the smart stop out mechanism in order to protect your position, in order to for you to maintain the current situation on your trading account. So what did we learn today from our quick meeting regarding the dynamic leverage and regarding the smart stop out? The first thing is that the dynamic leverage for every pair can be found here, as you can see here, below 10 millions, which is, of course, below 100 lots. The leverage is 1 to 500. 200 lots, between 100 and 200 lots, 1 to 200. Between 200 to 300 lots, 1 to 100. Between 300 lots to 500 lots is 1 to 50, and above 500 lots, it's 1 to 33. That's the example from the euro dollar. We can have different situation when we trade, for example, Bitcoin. The Bitcoin leverage is always 1 to 10, because it's a very, very, very violent market, and this is the level of the volume that TopFX provides, 1 to 10. For example, another leverage is for US dollar. Let's say US dollar to the Swiss franc. Let's stick to this example. There you go. The same situation. Dynamic leverage can be applied. When we talk about the metals, for example, we are using the gold. Dynamic leverage is as follows: up to 75 lots, there is 1 to 200. Above 75 lots, 1 to 100. The same situation is to silver. Let's take a look at the silver. Exactly the same situation, and all of the other precious metals might have different settings here. For example, zinc is, of course, 1 to 20, for example. If we take a look at the energies, and for example, the crude oil here situation, this is the dynamic leverage. Dynamic leverage is below 25 lots is 1 to 100. Between 25 and 75 lots, 1 to 40, and between and everything above 75 lots is 1 to 20. The similar situation is with the natural gas and, of course, the Brent oil. And if you find if you play with this watch list of the possible markets to trade, you will find out that the different markets have a different dynamic leverage. So please keep an eye on this, what kind of a dynamic leverage is being offered by a certain market. Where do you find information about the smart stop out? Well, if you take a look here, you can see clearly that there is a smart stop out, and if you at the level of 30%, which is even smaller than the 50% used by me in the example, yeah, for the educational purposes only, the smart stop out in the TopFX is set at 30%. So if you hover around this this smart stop out placement here on the trade panel, you can see the explanation. If the margin level, of course, shown to the left, which is this one, right? If the margin level is below smart stop out level, positions will start being closed until margin level reaches above smart stop out. Position with the biggest margin requirements will be closed fully or partially in order to restore margin level and protect the entry point, the positions, and the account for as long as possible, right? So this is very interesting information you can find out here. If there is enough for the smart stop out for example, to close the position by one micro lot, that might be enough. But please remember that in case of the of any other recalculations, the smart stop out might, in order to protect the entry point positions and the account, the smart stop out might close the biggest margin taker position that takes the biggest margin fully. Okay, so please be aware of this fact that this kind of a situation might happen, and this is a perfectly normal behavior for the smart stop out. So two very interesting features in the cTrader. And I think this is another advantage of the cTrader, that the beginner traders, the advanced traders, the semi-advanced traders, the semi-immediate traders should take a look at and should try in their own trading and apply it to their own strategies, and of course to the certain markets they are trading using the forex broker like TopFX. That's everything I wanted to show you guys in this webinar. I see that you don't have too many questions. Let me just switch back to the panel. I don't see you guys have many questions, so thank you very much for your time. Thank you very much for being here with me today, yet on another free weekly webinar from the series of Become cTrader Master. I hope I see you guys next week with another very interesting presentation. So thank you very much for being here. Have a great week and see you next time. Bye bye.